All right, welcome to Talk Tickers. Today we're tackling a really interesting one, Banco Macro's Q3 earnings. Now, you might have just seen the headline, a huge loss. But then the stock just shot up. So what's going on here? How does that even happen? Well, we're going to dig in and show you exactly what the market was looking at that the headlines completely ignored.
Okay, so let's get right into the thick of it. I mean, on the surface, this looks like an absolute disaster, right? The bank reports a GAAP EPS loss, missing what analysts expected by over $1. That's a huge miss. But then you look at the stock, and it rockets up 7.5%. It just doesn't add up. So the big question, the one we're here to answer, is what on earth did investors see that made them ignore that ugly headline number? And right here, this is our first big clue. Yeah, the EPS, the bottom line, it cratered. But look up top at the revenue line. They actually beat expectations by more than $78 million. So what does that tell you? It tells you the core business, the engine of the bank, was actually humming along just fine. Something else, something big came along and just wiped out all the profit. So to figure that out, we've got to listen to the story that management told.
So what was that story? Well, they called it a perfect storm. Look, management was pretty upfront about it. They said, hey, we did not expect to post a loss this quarter. They basically framed it as a period where a bunch of bad things all hit at the exact same time, and they decided to just take all the pain at once, rip the Band-Aid off and clean up the books for what's coming next. And here you have it straight from the CFO, Jorge Scaringe. He's saying, look, a bunch of things happened, and some of them were a bit deeper, a bit worse than what we thought. He's basically admitting, yeah, this one got away from us. And this combo of factors is really the whole story behind the loss. And the key word here is temporary.
Okay, so what was the biggest factor? It was this right here. And absolutely staggering. I mean, look at that number, a 424% explosion in what they call loan loss provisions. Basically, the bank saw more people falling behind on their loans, what they call NPLs or non-performing loans, and they decided, you know what? We're going to set aside a ton of money to cover all of these potential losses right now. And that was the number one profit killer this quarter, no question.
But hold on, it wasn't just the provisions. Management pointed to a few other culprits that made up this perfect storm. First, they had a one-time cost for an early retirement plan. Simple enough. Second, their bond portfolio took a hit because of market volatility. They had to write down its value. And third, their net interest margin. That's just the profit they make between what they charge for loans and what they pay for deposits. It got squeezed really hard. So you add all that up, and boom, there's your net loss. And right here, this is the absolute key to understanding that stock pop. This is the aha moment. Investors basically took the income statement, the P&L, with its big, ugly loss, and they kind of just threw it in the trash. Why? Because the balance sheet, the foundation of the bank, was telling a completely different and much, much stronger story. And that's what Wall Street grabbed onto. I mean, look at this. Total financing, the actual business of lending money, grew by a whopping 69% from last year. That's huge. The core engine is not just running, it's humming, especially in the private sector and with more US dollar loans. That tells you that underlying demand is just incredibly strong. And if that wasn't enough, just look at their capital position. The bank is sitting on a mountain of cash. We're talking 3.3 trillion pesos in excess capital. That is 265% more than they're even required to have. Think about that. It's like a fortress balance sheet. It gives them this incredible war chest for growth, for buying other companies, or frankly, for weathering pretty much any storm that comes their way. Okay, so that's the story of the messy quarter, a one-time cleanup, but the stock didn't just rally because the balance sheet looked good. It rallied because management gave a really clear picture of where they're headed. They laid out this whole multi-year plan to get their profitability, what's called return on equity or ROE, back up to some really impressive levels. And it wasn't vague either. They gave a specific roadmap. So for this year, 2025, they're saying, hey, we're still going to hit an 8% real ROE. That means they're expecting a huge bounce back in Q4. Then, 2026, they see that climbing into the low 10s. But the real prize, the thing that gets investors excited, is 2027 and beyond. They're aiming for a sustainable 20% real ROE. Now that is the long-term story that people are buying today.
And they didn't just pull that number out of thin air. They backed it up with some hard targets for 2026. They're talking about explosive 35% real loan growth, 25% deposit growth, getting that net interest margin back to a healthy 20%, and having their cost of risk, those provisions, come way back down to a normal 5%. I mean, if they can hit these numbers, getting to that low 10s ROE is absolutely in the cards.
So the question is, how do they get there even faster? Well, it all comes back to that giant pile of cash we talked about. The next big thing to watch, the real catalyst, is what they do with all that excess capital to create value for shareholders. And we got a huge clue about their strategy on the call. They said, you know what, the share buyback is on pause. And the reason? Their words, the stock skyrocketed, and they don't think it's a good deal to buy their own stock right now. So what's the new plan? It's shifted completely to M&A, mergers and acquisitions. They basically put the market on notice. Expect to hear something about a deal in the next year to year and a half. They are officially on the hunt.
All right, that brings us to our final take, what we call the next call. We've broken down the messy quarter, we've seen the strong foundation, and we've heard the plan for the future. So let's put it all together. What does this actually mean for the stock going forward? So what's the play? What's the trade? The market has clearly already bought into the turnaround story. It's looking past this quarter and pricing in that future recovery. So where's the edge now? How do you make money from here? Okay, here's the talk tickers thesis. First, our Q4 prediction. We expect them to get back to making good money. Management basically promised that margins will recover and that the big provisions are over. If they deliver on that, it proves this was just a cleanup quarter. Second, the stock price. Look, a lot of the recovery is already baked in. The next big move up will have to come from a catalyst, and we think that catalyst is M&A. News of a good deal is what will kick this stock into a higher gear. So our rating is outperform. We think the market is going to keep giving them the benefit of the doubt, ignoring any short-term bumps, and staying focused on that very attractive long-term profitability target.
And as always, remember, this is not financial advice.